Imagine the power of investing like one of the greatest investors of all time. Warren Buffett's investment strategies have been proven to generate outstanding returns over the years. He has become one of the wealthiest men in the world through his investment strategies with a net worth of billions of dollars. By following his approach, you too can potentially achieve financial success. According to a recent study, if you had invested $10,000 in Berkshire Hathaway, Buffett's holding company, in 1965, it would have been worth over $90 million by 2020. That's a compound annual growth rate of over 20%. These are the kind of returns that can change your life. In this video, we'll reveal the secrets behind Warren Buffett's success as an investor and show you how to apply them in 2023, with the current state of the economy providing a unique opportunity to put these strategies into action. Now is the perfect time to start investing like Warren Buffett and potentially achieve financial success. So, if you're ready to learn how to invest like Warren Buffett and take control of your financial future, keep watching. To truly understand Warren Buffett's investment strategies, we need to take a look at his investment philosophy and the principles that guide his decision making. At its core, Buffett's investment philosophy is about finding undervalued companies with a strong competitive advantage and holding onto them for the long term. He believes in a value-based approach where he looks for companies that are trading at a discount to their intrinsic value. An example of Warren Buffett's investment philosophy is his long-term investment in Coca-Cola. In the late 1980s, people were concerned about the health impact of sugary drinks and competition from other beverage companies. As a result, the stock was trading at a significant discount to its intrinsic value, with an average price around 50 cents per share. However, Buffett believed in the company's strong competitive advantage, which included its well-known brand, wide distribution network, and loyal customer base. He also believed that the company would continue to generate consistent earnings over the long term and would be able to weather market downturns. As a result, he held onto the shares for the long term, and over time, the stock price of Coca-Cola has grown significantly, trading at around $50 per share today, generating significant returns for Berkshire Hathaway, with an estimated profit of $13 billion. Buffett follows a principle of margin of safety, which means he looks for companies that have significant cushion in case of any unforeseen events or market fluctuations. An example of this is his investment in American Express in the 1960s, when the company faced a scandal and its stock dropped significantly. However, due to its strong fundamentals and competitive advantage, Buffett saw it as an undervalued opportunity and invested a large portion of the Berkshire Hathaway's capital. The company recovered, and the investment generated significant returns for the firm. Buffett also follows the principle of circle of competence, which means he only invests in industries and companies that he understands and can analyze effectively. An example of this is his avoidance of investing in technology companies. Despite their potential for growth, he felt that he didn't have a deep understanding of the industry and therefore refrained from investing in tech companies. By following these simple principles, Buffett is able to identify undervalued companies with strong competitive advantages and hold on to them for the long term, which has led to his outstanding investment performance over the years. Keep watching to learn more about Warren Buffett's specific strategies for identifying undervalued companies and how you can apply them in 2023. Now that we've covered Warren Buffett's investment philosophy and principles, let's dive into the specific strategies he uses to identify undervalued companies. One of the key strategies that Buffett uses is analyzing financial statements. He looks at key metrics such as the price-to-earnings ratio, the price-to-book ratio, and the debt-to-equity ratio to determine a company's intrinsic value. The price-to-earnings ratio, P/E ratio, compares a company's stock price to its earnings per share. A lower P/E ratio indicates that a stock is undervalued and may be a good investment opportunity. The price-to-book ratio, P/B ratio, compares a company's stock price to its book value. A lower P/B ratio indicates that a stock is undervalued and may be a good investment opportunity. The debt-to-equity ratio compares a company's total debt to its total equity. A lower debt-to-equity ratio indicates that a company has a strong financial position and is less leveraged. A lower P/E and P/B ratio indicates that a stock is undervalued, and a low debt-to-equity ratio means a strong financial position. These metrics give him a general idea of the company's financial health and potential for growth. He also conducts extensive research and due diligence before making any investment decisions. Another key strategy that Buffett uses is looking for a strong competitive advantage, also known as a moat. This can include things like a strong brand, consistent earnings, and patents or other barriers to entry. The term moat refers to the metaphorical moat that surrounds a castle, which makes it difficult for invaders to enter. By identifying companies that have a strong competitive advantage, Buffett is able to invest in companies that are likely to continue performing well over the long term. These are just a few examples of the strategies that Buffett uses to identify undervalued companies. By understanding and implementing these strategies, you'll be well on your way to finding undervalued companies with a strong competitive advantage and making profitable investments in 2023. By now, you have a good understanding of Warren Buffett's investment strategies, but how can you put these strategies into action in a practical way? One tip is to start by creating a list of companies that you are interested in, and then researching their financial statements and competitive advantages. Look for companies that are trading at a discount to their intrinsic value and have a strong competitive advantage. Another tip is to diversify your portfolio by investing in a mix of companies from different industries and sectors. This will help to spread risk and increase your chances of success. It's also important to have a long-term investment horizon and to not get swayed by short-term market fluctuations. Buffett himself famously said, "Our favorite holding period is forever." Finally, it's important to stay disciplined and stick to your strategy. Don't get caught up in the hype of the latest investment trend or hot stock. By following these tips, you'll be well on your way to building a Warren Buffett-style portfolio in 2023. Now that we've covered the key strategies of Warren Buffett's investing approach, let's review the main takeaways from this video. Number 1. Long-term focus. Buffett's investment philosophy is centered around a long-term approach, which allows for a more stable and sustainable investment strategy. Number 2. Thorough research. Buffett's strategy emphasizes the importance of conducting thorough research and due diligence on a company before making an investment. Number 3. Minimizing risk. Buffett's approach to investing also includes a principle of margin of safety, which means that he prefers to invest in companies that have a significant cushion in case of any unforeseen events or market fluctuations. Number 4. Circle of competence. Buffett only invests in industries and companies that he understands and can analyze effectively. Number 5. Using financial metrics. We highlighted how Buffett uses financial metrics such as P/E ratio, P/B ratio, and debt to equity ratio to determine a company's intrinsic value. Number 6. Taking action. Finally, we encourage you to take action and start implementing these strategies into your own investments to potentially achieve the same level of success as Warren Buffett. Keep in mind that by following these strategies and tips, you'll be well on your way to achieving your financial goals in 2023. We've provided some resources for further learning and research, such as books like The Intelligent Investor and The Essays of Warren Buffett, and websites like Berkshire Hathaway's. These resources can help you deepen your understanding of Warren Buffett's investment philosophy and strategies. You can find links to these resources in the video's description down below. I encourage you to take advantage of these resources and continue your education on investing. By doing so, you will be better equipped to make informed investment decisions and achieve your financial goals in 2023. So, take action and start building your own Warren Buffett-style portfolio today. The benefits of investing in the long term can be substantial. If you found this video helpful, please share it with your friends and family, and don't forget to subscribe to our channel for more investment tips, and stay tuned for more valuable content. Thanks for watching. Until next time, let's turn learning into earning.